These are 3 Singapore stocks that are growing faster than Facebook, Google, and Apple. Hi guys, Stanley here. Singapore has been known as a great stock market for dividend investor. The Straits Times Index is providing a strong and attractive dividend yield of more than 3%. And many of the REITs in the market has a distribution yield of more than 4%. This is extremely attractive in our current low interest rate environment. But the one thing that investors do not associate with the Singapore market is growth. Interestingly, there are still some growth companies within the Singapore stock market if we know where to look. So here are 3 growth stocks in Singapore you need to know about. Number 1, AEM Holdings. AEM Holdings is a system test and handler solution provider for the semicon industry. In particular, it produces a high-density test handler for its key customer, Intel. Today, the company has a market capitalization of 1.1 billion Sing dollar, and the company has been growing strongly with the blessing of Intel over the past few years. Its revenue grew 66% a year over the past 3 years, while its net profit is up 124% a year over the same period. The financials of the company are great, sitting on close to 130 million Sing dollar in net cash. It also has a strong profit margin of 19%. Yet, for such a fast-growing company with a strong balance sheet, its stock price is only trading at 13 times its earnings. The key reason for its low valuation might be the uncertainty surrounding its business. For one, the company does not share much information about the prospect going forward. It might be to protect its key customers, as analysts has estimated that Intel contribute up to 90% of the company revenue. This means that AEM Holdings has a huge customer concentration risk. If Intel decides to scale back on its relationship with AEM, it could have a big impact on the company. Such an event has indeed happened in the past. From 2011 to 2014, the company revenue dropped from 100 million to just 31 million before recovering. Therefore, AEM Holdings is a company that has shown great growth, but it is still unclear if they can sustain that growth going forward. If AEM Holding is not a stock for you, maybe we can look at the next company, Nanofirms Technologies International. Nanofirms IPO'd on the Singapore Exchange back in October 2020. Since then, its stock price has rallied close to 100% from $2.59 per share to $4.65 per share, giving the company a market capitalization of $3.1 billion. Nanofirms has 3 main segments of businesses: advanced material, nano fabrication to industrial equipment. In advanced material, the company provides surface coating solutions using its technology for the consumer electronics, the automotive, and the communication industry. In nano fabrication, it has the know-how to produce optical lens and other sensory components for its customer. And lastly, it also designs and produces industrial equipment for coating, cleaning, and automation purposes. Today, close to 77% of its revenue is coming from its advanced material division. The company has also seen some strong growth. Both its revenue and profit has risen 17% a year over the past 3 years. Nanofirms also command a strong net margin of 26% and has a net debt to equity ratio of just 0.3 times. However, Nanofirms faces the same issue as AEM Holdings, where its largest customer accounts for 56.5% of its revenue. Although the company has over 300 customers, the top 5 customers contribute close to 82% of its revenue. On top of that, with a PE ratio of 74 times, the company has a valuation not many investors are comfortable with. Lastly, we have iFAST Corporation. I do consider iFAST as one of the first fintech companies in Singapore, even before fintech is officially a term. The company has started as just an online portal for investors to buy unit trusts. Now, it has evolved into a full-service financial company with a brokerage, wealth management, and insurance platforms. It is also a key software platform to help financial advisors to manage their clients' wealth. iFAST counts Singapore, Hong Kong, and Malaysia as its key core markets. But it has also recently established a presence in China as well. iFAST has been growing its revenue at 16% and its net income at 20% a year over the past 3 years. The company has a very strong balance sheet, sitting on a net cash position now. iFast has also shown that it has great innovation in its product offering, and with its position in Singapore and Hong Kong, it can also tag on to both cities' growth as the financial centers of the region. This means that as Singapore and Hong Kong continue to grow, iFast should be able to grow as well. Unfortunately, we have shown in the previous two examples that no company is perfect. The key cause of concern for investors with iFast would also be its high valuation. Trading at close to 100 times PE, this company is trading at a valuation so commonly seen on Nasdaq, but it is still a very rare sight in Singapore. So there you have it, 3 Singapore companies with great prospect. However, all of them has some risk associated with them, be it having a high customer concentration risk to a high valuation. So investors need to weigh the risk and reward before making a decision. But which of the 3 do you like the most? Comment down below and let me know. If you want to know more about investing, remember to check out our free investing course at valueinvestasia.com/free course. If you enjoyed this video, remember to give us a like and subscribe to our channel so you won't miss out on any of our videos. As always, till we meet again, my name is Stanley. Invest safely.